Good morning, ladies and gentlemen, and welcome. Whilst the pandemic has brought many challenges and sadly sorrows, it has also created opportunities. When it comes to our money and financial matters, one such opportunity is that we're able to connect with you online as we are doing this morning. At Nedbank Private Wealth and Nedbank Financial Planning, we use our globally integrated advice-led approach to connect your financial decisions to your life goals and aspirations. Practically, this means providing our clients with technical expertise, appropriate opportunities, global products and solutions across Nedbank and other institutions. But most importantly, it's about connecting you to personal and objective advice that can enable you to make better financial decisions and avoid financial disasters. And in essence, this is what we refer to as connected wealth. In our webinar this morning, we're going to be discussing the factors affecting the future of financial wealth in South Africa with the Honourable Judge Dennis Davies, who has kindly agreed that we can dispense with official titles. So by way of introduction, Dennis is a judge of the High Court in Cape Town. He is an honourable professor at UCT in the fields of tax, constitutional law, competition law, and legal theory. He is the author of numerous books. He was a member of the Cats Commission, appointed by Nelson Mandela in 1994. And more recently, he's been appointed as the chair of the Davies Tax Committee by the Minister of Finance in 2013, Pravaan Gordhan. So Dennis, a very warm welcome to you and thank you for joining us this morning.
Pleasure.
So really just some housekeeping. In the next few days, you are going to receive an email. In that email will be a link to this webinar, so you will be able to view it again, and you'll also be able to share it with your friends and family. Thank you to all our clients that took the time to submit questions ahead of this webinar. And what we have tried to do is we've tried to address those questions by making sure we weave them into the content that we're going to be covering this morning. But to everyone online this morning, please make use of that Q&A chat box on the right-hand side and please submit the questions to us throughout the webinar. So really just in terms of the format of today's session, I'm going to briefly explain to you shortly what we mean by financial planning and position a few other things. And then we're going to get into the meat of the webinar today. And the meat of the webinar today is really to discuss those interconnected factors that affect the future of financial wealth in South Africa. And just to provide a little bit of structure to that particular section, I am going to briefly position each of the factors, and I'll take you through some of the key considerations of those. And then we're going to be engaging with Dennis, and we're going to be obtaining his insights in terms of a Q&A type format. And then lastly, what we're going to do is we're going to try and bring it all together for you and leave you with some parting thoughts. So really, what do we mean by financial wealth? Well, at its core, financial wealth is the net asset measure of the assets that we own. And by net asset measure, I mean the value of the asset less the liability gives you that net measure. Now, for some of us, our financial wealth could be our employee-based pension fund that we so diligently contribute towards on a monthly basis. And or it could be the property in which we reside, less any outstanding bond. Whilst for others, financial wealth could be the accumulation of different assets. But when it comes to our financial wealth, whatever that means for each of us, there are reports in the media that start fueling fears. And whether it's prescribed assets in relation to our pension fund, appropriation of land without compensation if it's our property, or if we own various assets, this renewed call for wealth taxes, these do fuel fears. And it can often be hard to distinguish between what is fact and what is fiction. What do we know for certain and what is mere speculation? But when it comes to uncertainty, it's also important to distinguish between the things that we can control and the things that we cannot control. And despite this ongoing uncertainty, there is in fact a lot that we can control. And in the context of our money and financial matters, we can control the extent to which we plan for the future. We can also control how we choose to plan for our financial wealth to ensure that we protect our dependents and our loved ones when we are no longer able to do so. And really, in essence, planning for the unknown is the cornerstone of any sound financial planning. And in terms of the things we cannot control changes in legislation or regulation. We cannot control the inevitable that we do have to pay taxes. And there's a lot of things that we cannot control. But in terms of those things, it's always important to try and identify those little silver linings, those little opportunities that can be created from the things that we cannot control. And when it comes to our money and financial matters, some of those opportunities or silver linings are the fact that we can globally diversify our portfolios or our financial wealth to obtain exposure to other markets and currencies. Market perceptions fueled by fear can also create distortions of value, i.e. it can create buying or selling opportunities. So whilst there are things we cannot control, we do need to try and spot those silver linings in terms of the opportunities that they do bring. So in terms of these interconnected factors that we're going to be discussing, I think this visually just shows that interconnectivity between each one of them. But I think before we start unpacking these and bringing Dennis now into the conversation, Dennis, perhaps you could just kindly clarify what the role and mandate of the Davies Tax Committee is. How much power or influence do you really have when it comes to policy making? And considering the various reports that have been prepared since the establishment of the Davies Tax Committee, perhaps you could just share with us what you're currently working on.
Okay, thank you, Tracy, and thank you for inviting me. It's an interesting question, and interesting because really it divides out into two areas. You did mention earlier that we were appointed by the then Minister of Finance, Praveen Gordhan, and indeed I don't suspect that any Commission of Inquiry into Taxation anywhere in the world would have actually had as many ministers to whom we served than in fact we have. We started off with Minister Gordhan. We then moved to Minister Nene. For a weekend, we had Minister Van Rooyen. Then we had Minister Tagaba. And then, of course, now we have Minister Mboweni. Now, I mention this not to try to be funny about it. As I say, 2 bites of Minister Gordhan, Nene, Tagaba, and Mboweni. But it's because we had 2 basic periods. When we were first introduced in 2013 by Minister Gordhan in his first term as Minister of Finance, our objectives were comprehensive: to develop a tax policy for the future of South Africa. And that, if you look on the website, a whole range of documents were prepared in relation to VAT, income tax, corporate tax, estate duty, wealth taxes, etc. What then happened was we got caught up in what you could call the Mayani period. And effectively, Mr. Mayani refused to cooperate with us. So, for example, and it is relevant to this conversation, we were working on a document on trusts, and we were not able to complete that because Mr. Mayani refused to allow SARS to have anything to do with us. So by the end of Mr. Mayani's era, not only was SARS in terrible shape, but we were really in a position where we could do very little. And the reason I mention that, Tracy, is because subsequently our job has been to look at the tax gap, and that does become relevant to today and to this conversation today. And let me tell you why. Because ultimately, as we will discuss through the seminar, the biggest possible increase in collection of tax is not in raising taxes, but having a more efficient tax system. So what we've been doing over the last couple of years effectively is to look at what's called the tax gap. What is the difference in the nominal amount that you expect to collect and the effective amount that you do collect? And we've done that by way of high net worth individuals. We've done that in terms of VAT, and we've done that in terms of corporate tax. You ask What influence have we had? I think the biggest single influence we've had is persuading the minister, and we weren't the only ones, to grant SARS an extra 3 billion and to effectively change the trajectory of the way in which SARS is going to work to deal with high net worth individuals, to deal with customs, to deal with VAT, and to deal with corporates. The second aspect, and the one that we really are working on at the moment, is how do you deal with the problem that you've got a huge amount of delinquent people who are criminally liable because of the fact that they've evaded tax, when you've got an NPA, which, not to put too fine a point on it, is overstretched and undercapacitated. And what we're working on is how do you allow SARS, what legislation will we require and what proposals can be made to ensure that SARS actually prosecutes these cases, because that would be a far more successful way of closing the tax gap by increasing the level of deterrence. Do we have influence? I think we've had influence in relation to the way in which SARS has thought about matters and the way the minister, as he indicated in his budget speech. But it's always hard to tell when your advisors how much influence you really have. Over the years, they have listened to us. There's no question. And when tax increases were required, in a sense, we were the people who found the money. But of late, because there are no tax increases, it's much more in the administrative side that we're having some influence.
Perfect. Thank you, Dennis. So, and I think you've touched on a couple of things there, which takes us, I think we need to start unpacking those factors that do affect the future of financial wealth. And I think the first factor, and you've alluded to it there as well, is the recent budget. And I think, if we look at the fact that the dust has kind of settled on the budget, it's about a month ago since Tutu Mboweni delivered the budget. But I think there were, if we look at the tax policy changes over the medium term, and I think you've touched on some of these as well. So I think we are seeing that, in fact, the Davies Tax Committee is quite influential when it comes to policy making. Because I think if we look at the budget policy proposals or changes announced over the medium term, there were three kind of key themes that stood out for us. And I think the first theme was around the focus towards those people that are paying tax. And there was almost a recognition to the contribution that those people are making to the fiscus. And there was also an acknowledgement that the current income tax rates, and in particular the individual income tax rates and the corporate income tax rates, are not competitive. I think the second theme, which you touched on there as well, Dennis, is really this focus towards those that aren't paying tax, with the aim being to improve the overall collection from a SARS administration perspective. And then the third thing that from a key theme emerged was really this shift towards simplification, i.e. trying to do away with a lot of these complicated incentives for certain taxpayers. And when we talk about certain taxpayers, in particular when it comes to corporates. So I guess, against that backdrop, with these kind of key themes that emerged, and just for the purposes of all our clients online today, maybe just to give you a brief insight in terms of the budget proposal, specifically wearing a financial lens that would potentially impact financial wealth. So the first one was around corporate income taxes, and we did see the announcement that the corporate income tax rate will be reduced from 28 to 27%. There is a view to further reductions over the medium term, but in terms of those complicated incentives that I referred to earlier, there is going to be a broadening of the tax base with really doing away with those complicated incentives, in particular for corporates. From a personal income tax perspective, once again, that acknowledgement towards those individuals that are indeed contributing, and the substantial contribution that personal income tax does contribute to overall tax collected. We did see that an acknowledgement of the fact that we have one of the highest top personal income tax rates in South Africa. And we also saw the announcement that although we didn't see any increases or decreases in the rates, we did see the above inflation adjustments to the tax brackets, but clearly the intent being to reduce the personal income tax rate over the medium term. But with the focus then shifting towards ensuring that we can grow that tax base and improve collections and enforcement. From the rebuilding of SARS perspective, and indeed, Dennis, once again, that 3 billion that you alluded to earlier being allocated, and that's really designed to modernize SARS's technology and infrastructure systems, as you alluded to earlier. And we have also seen the re-establishment of that high net worth unit. And in particular, there was the announcement that SARS has been paying particular attention as a result of automatic exchange of information to those individual taxpayers or taxpayers that have undeclared offshore assets. From a retirement reform perspective, we saw the much anticipated annuitization of provident funds coming into effect from 1 March. But also very importantly here, we saw the draft amendments to Regulation 28 of the Pension Fund being published. And really the whole intent behind the amendments is to make it easier for retirement fund managers to invest in infrastructure. But almost a complete shift in the tone, because a shift away from this prescribed basis more to a discretionary basis. And then lastly, just kind of a key takeout in terms of financial wealth from the budget, and that's the exchange control announcements that were made. But very importantly, these exchange controls are really back on the back of the exchange control reforms announced in last year's budget. But in particular, we saw the abolishment of the definition of an immigrant for exchange control purposes. And effectively, those individuals that are looking to emigrate from 1 March this year will need to follow the tax process to cease to be South African tax resident. And from an exchange control perspective, if one does emigrate, one will now be deemed to be a resident for exchange control purposes. But also there was the announcement that we are going to be seeing a lot more of these changes to an exchange control perspective taking place this year. So indeed, I think just if we look at the summary, there was quite a lot that actually did come out of this recent budget. But Dennis, perhaps turning to you now, and I mean, you alluded to it earlier in terms of of trying to motivate to get an additional funding to SARS. But in terms of rebuilding SARS, what are some of the challenges being experienced currently? And is this 3 billion going to be sufficient to address all of those challenges?
I'm not sure 3 billion will be sufficient, Tracy, but it certainly helps. And of course, it helps in at least two ways, two fundamental ways. One is, of course, at one particular point in time, not that long ago, probably when Praveen Gordhan was the Commissioner of Inland Revenue and even thereafter, SARS actually had technological capacity and data scientists, which was as good as anywhere in the world. That sadly it was degraded considerably, and therefore you're right, a lot of money will have to go in to the recalibration of the IT part. But there's another part, is we're actually very intent, and we've been reaching out to the profession, particularly the accounting profession, have been a lot better than the legal profession in this regard, I might add, sadly, since I'm a lawyer. But they've actually been prepared to go to their members, and we're literally looking at two categories of people, and that will also essentially draw on the 3 billion to some extent. That is to get a cadre of people who've retired, accountants who've retired, forensic accountants, who are prepared to come and work for SARS for a couple of years, and then younger people, perhaps who are qualified accountants, perhaps the tax qualification, who will work for SARS for a couple of years and totally recalibrate the auditing capacity of SARS. So the idea is, if you wish, to ensure that SARS now has a greater level of expertise in the key areas. And the key areas are high net worth individuals. We can come back to that if you wish, and I'll explain. There is unquestionably a level of transfer pricing and similar manipulation by corporates world over, and South Africa is not an exception in this regard. We have got significant problems on the customs side. You know, customs brings in about 100 billion, literally about 8% of the tax take, but it could bring us so much more because of the hemorrhaging, and that distorts economic activity considerably. And we have found massive manipulation in the VAT system for all sorts of reasons, which have to actually be cured. So the idea is, yes, we do need better technology, but we also need, as it were, boots on the ground to deal with it, and that's the idea. There is no question that SARS suffered enormously. What were the problems? The problems were the collapse of the high net worth individual investigative unit, the large corporate center, the inability to effectively audit VAT and VAT refunds and customs, and all of this. Well, anybody who listened to some of the evidence given before the Zondo Commission will know, but if you really want to know how SARS was degraded, have a look at the Nugent report, which just tells you in terms. So that's what we're trying to prevent, is we don't want more. There is no, and you alluded to this, there is very little scope for tax increases in South Africa. And your audience needs to understand this. I can't guarantee that, and neither can the Minister of Finance, because at the end of the day, so much of this depends on the political question. But if you look at the Treasury position, if you look at the Minister's position, if you look at our position, if you look at anybody who's half sane, they will know that if you look at the way in which our tax system is calibrated, there's very little wriggle room for increases. And you'll have noticed that in the budget review, a reference was made to study by Kemp in 2020, just showing the extent to which you actually impair economic growth if you get your tax increases wrong. So the only real scope for increasing revenue is better collection and more efficient collection and closing the tax gap. And that's why the infrastructure, IT, and getting people who've got some expertise into SARS in significant numbers, a couple of hundred, will make a massive difference.
Yeah. So Dennis, just one of the things I'd like to perhaps just pick up on that you mentioned is retired accountants and trying to see how you get retired accountants into SARS. So, I mean, I'm just thinking, but if we do have any retired accountants, I can think of one in particular, but if there are any retired accountants on the line today and they would be interested to get involved, how would you suggest they go about that?
They can certainly email me, or they can actually approach SAICA, because SAICA and SARS, in which I'm involved at the moment, we're trying to settle a memorandum of understanding precisely that, and they will then be reaching out to their members, which would be people who've retired as well. It's an absolutely critical enterprise. And I can't emphasize that is the future over the next few years in relation to tax policy.
Yeah, agreed. So Dennis, I mean, just another question, and we mentioned that there is this shift towards those that are not paying tax. So, you know, and considering this focus towards growing the tax base, in your opinion, who is it that is actually being targeted?
Well, there are a series of groups. Let me give you an example. I think it's terribly important that we actually clarify this properly, because in all of the talks that I've given, I know that the reaction comes back, you want to tackle us. And the answer to your members, to the people listening to this program, is those people who ultimately are tax compliant. And what I mean by that is, frankly, I'm not worried, and it would be crazy to be worried about people who are a couple of thousand rands here or there. I mean, everybody probably claims, you know, for an extra meal or goodness knows what in the DAX. That's neither, it's de minimis. What you're worried about are significant holes in the system. And I'll give you two or three. So the first is, of course, the high net worth individuals. If you look at the tax tables, basically only 5,000 people in South Africa report taxable income of 5 million rand or more. And that makes no sense to me, because I invite people to drive down in Sandton and Bryanston or Camps Bay, Bishop's Court, or similar neighborhoods anywhere. I'm sitting here at the moment just outside Plettenberg Bay. I mean, the amount of houses that are owned by people here, you just count them up and you say, you have to be earning significant sums of money if you can afford a house like that as your second house. And I'll give you an example. So when you say targeted who? So we did a little study the other day where a whole group of people with very fancy Ferraris parked outside a hotel, and the revenue person who I've been working with, some of them, somebody took the registration numbers of 26 of these Ferraris, correlated that to the taxable income that they return. Turns out that none of these people return taxable income of more than 400,000 rands a year. Now, I'm sorry, why should, when people say to me, you want to tackle people, I don't want to tackle, and neither does SARS want to tackle people who've got Ferraris who reflect their proper adequate tax income. But you can't have a country where people are doing this. So that's group one. Secondly, the banks, and particularly one of the large banks, drew our attention to incredible VAT fraud in a second-hand gold scam, which I'm not going to bore your audience with the techniques. But it turned out billions of refunds were being claimed illegally in that particular regard. Significant. The third issue, as I've indicated to you, is customs. What's happened is there's a sort of round-tripping situation. So what you get is people bringing goods in at absolutely no price, therefore, like clothes, therefore undermining the local industry, or in any and all areas. And I've had all sorts of business people telling me this, and then we've got cases to this effect. And then what happens is, so they bring them at nothing, and then they sneak out the profits by way of marketing and recruitment and legal and other forms of costs to an offshore entity, so that they don't pay tax, and nor do they pay customs. It's a huge scam. That's why the Commissioner and I both believe that we are losing more than 100 billion each year. Let me repeat that. That's almost 10% of our tax take.
Yeah.
That's our target.
Yeah. So as you say, Dennis, I mean, for those that are paying tax, there's nothing to fear. But really what you're saying is those that aren't paying tax, I think, the time is running out. I mean, just interesting, Dennis, looking at the...
Sorry, Tracy, can I make one other point? Because I think it's relevant to your audience to understand this too, because I know there's been a lot of misconception about this. And thank you for suggesting, quite rightly, that we are not interested in people who are basically, and I mean that broadly, tax compliant. I'm not talking about 100%. This is not some Stalinist enterprise where you knock on the door because you haven't paid 3 rand. What I'm talking about is a significant pools. But here's the other thing. If I had my way, and I'm certainly going to be pushing this, I would want a tax official at all of these, at the Zondo Commission, at all of these large criminal cases where a sort of corruption is the order of the day, because I would want every single person where there are credible allegations that they've been participants in corruption to be properly audited with lifestyle audits and proper audits. Al Capone is the best technique to stop corruption. And if we can do that, I assure you, far better than the NPA, we will bring people to book.
Agreed. And Dennis, I mean, just so that you know, I'm just looking at the Q&A function, and there is quite an interest from quite a few clients to take you up on that offer in terms of retired accountants, etc. So those, just to those clients. Yeah, and just to those clients, we will forward you Dennis's email, and we'll make sure that you are able to get in touch with him. So I think, Dennis, another thing that did come out of the budget proposal documents, and this kind of sets us up for the next topic, and also it kind of connects in with the rebuilding of the SARS data for taxpayers through the collection of third-party information. But the comment was made that will assist in broadening the tax pool, which I think we've spoken about, improving tax compliance, but also the comment was made that will assist in assessing the feasibility of wealth taxes. So I think this very much positions the next topic quite nicely. And really, I think at the start of the topic on wealth taxes, there's a few considerations that I'd like to just put out there. And I think the first is around the size of the tax pool and how do you determine, what is a wealthy individual? And these pie charts that you have up on the screen now, this is really information that was extracted from the estimates of individual taxable income for the 2021-2022 tax year. But from an income perspective, it does show us, if we look at the left-hand pie chart, I think there's something like 14 million registered individual taxpayers. But it does show us that over 50% of the registered taxpayers are falling in that 0 to 80,000 income category. We've then got the next biggest chunk, which is just over 4.5 million individual taxpayers that are earning 80 to 750,000. And as we start getting to the higher income levels, we start seeing those pools becoming a lot smaller. And in particular, if we look at this pool over here, 262,000 individual taxpayers, they earn between 750 and $1 million. And the pool gets smaller when we get to the 1 million to 1.5 million, where there's only 159,000 individuals. And then right at the top at the 1.5, there's a mere 113,000 individual taxpayers. So if we look at these small pools combined, currently it's about 500,000 individuals that are contributing, if we look at the pie on the right-hand side, that are contributing more than 50% of income collected. So I think that's just the one thing to consider if we're looking at it from an income perspective, that in essence the size of the pool is small. I mean, if we're going to look at the asset value of individuals, and it depends which wealth report one reads. I recently read the new World Wealth Report for December 2019, and in terms of those stats, in their estimation, there's about 38,400 USD millionaires in South Africa. If we look at multimillionaires, i.e. USD 10 million above, there's about 2,000. 92 centimillionaires of USD 100 million and above. And there's about 5 billion one USD billionaire. So the point that I'm trying to make here is just depending on how we define wealth, and I'm going to get to that a little bit later, the pool appears relatively small. And if we look at it from our perspective in terms of a good outcome of advice that we provide to our clients, it's never to place them at risk. And, accordingly, our advice, amongst others, is always to enable clients to understand what the tax consequences of the products and services that they have with us. So, according to our experience, I think the bulk of, the clients that are joining us today are sitting in those pools on that pie chart that are already contributing significantly. I think another consideration is just looking at the current wealth taxes collected internationally as a percentage of total tax revenue. And those are also very small. And not to go into stats, but I think, Switzerland, I think they're sitting at about 3%, but Spain, France, Norway, they're 1% or below 1%. So it's very small amounts that are actually being collected. And South Africa has, already has existing wealth taxes as well that I think we need to bear in mind, and we're going to touch on those in a little bit more detail. And then lastly, but by no means least, Dennis, is the Davies Tax Committee report on wealth taxes prepared in 2018. And I think, just looking at a couple of the extracts from the conclusion of that wealth report, there was an acknowledgement once again that the wealthy are already contributing significantly to the economy. You did highlight the need to consider the appropriate tax base, and you also highlighted the need to consider the administrative and economic burden that a wealth tax would place on taxpayers and on revenue authorities. And I think, one of your concluding comments was that the focus should initially be on increasing estate duty collections, and you made reference to the first and final report on estate duty, which we'll also discuss in the next topic. So Dennis, I think turning to you now again, and I think, considering this relatively small size of the wealthy pool, who is it that is actually being targeted once again with these wealth taxes? And what is your definition of wealthy?
Well, there are a number of points that you've made, so let's just start with the basic premise. The reason why there's an impetus for wealth taxes in South Africa is because of the fact that if you look at both the income and the wealth Gini coefficient, which measures equality or inequality of wealth, we are probably, together with Brazil, the most unequal society on earth. And that does present a problem. It presents a number of problems, which I don't have time to explicate on, but briefly, it undermines the legitimacy of the tax system, it undermines the legitimacy of the economic system, and it certainly creates a lot of scope for populists, of which we have more than a few in South Africa. That does not mean that you automatically plunge into a wealth tax as a result of that. The bottom line is that when you ask me what is the definition of wealthy, well, that's a really interesting question. You've got to do a number of things before you have a wealth tax. Number one, you have to define what you mean by wealth, as you rightly say, assets. Then you've got to be able to have a sufficient base to inform you of the people who've got those assets. And then thirdly, you've got to take out from those people, as it were, those who clearly would not be particularly wealthy and therefore should not be subject to the tax by way of exemptions. Now, none of that has been discussed. Why? Because we've nowhere near a wealth tax. Why? Because in order to have a wealth tax, you've got to have, as I've said, the asset base. You've got to have the knowledge of people who by the revenue of what it is that you people own in the country. And I assure you that we are nowhere near that. It's laughable to suggest that we could have a wealth tax this year, the next year, or the year after, in the circumstances where two things. Number one, SARS, as we've already indicated, is trying desperately to collect money owed to it in terms of the existing taxes. Secondly, there isn't the information to implement a wealth tax. Now, assuming, however, that a wealth tax was implemented, well, what would you do? My own guess is that you'd have to have it at a low rate. There have been bandied around about 5-6%. Absurd. You can't have that, because that means you take away the entire return. You take interest rates of 4 or 5 or 6%. What kind of wealth tax would you have? It couldn't be more than 1 or 2% on assets. And certainly, as we tried to say, and we'll talk about this later in relation to estate duty, one wants to take middle-class people out of that. And effectively, somebody with an estate of $1 million, which is roughly 15 million rand, if you work it out, depending on what return you're getting, you're probably getting anything, probably no more than 750,000 rands if you're lucky, 800,000 rands on that. So you are talking about extraordinarily wealthy people. It would have to be that high category, a very small category of people, at least double that before you could actually consider having a wealth tax, which means effectively you aren't going to bring in a huge amount of money. But there is one aspect about the wealth tax which one has to actually understand. The wealth tax, if it allows you to have accurate information about people's assets, would certainly be able to increase your take on the other taxes, because you'd be able to correlate them and effectively do more efficient auditing. Now, when you refer to the $38,000 millionaires, yeah, we know those figures too, but we can't be entirely certain whether they are accurate. And the reason for that is there are vast swathes of South African wealth outside of the country illegally by people who are resident in South Africa. And one doesn't quite know how much that is. I can tell you that about 3 or 4 years ago, when I was approached by a delegation of Swiss banks who wanted to clean up their act, because they did not want illegal, in breach of exchange control money to be in their books for obvious reasons, they told me that between a lot of them, they had a number of thousands of people with very significant amounts of money, way over $1 million each. And they thought that the figure was far higher, precisely because of their own information. They wouldn't give me direct information for obvious reasons. So what I'm trying to say, Tracy, is that I want to assure, I can't assure, but I want to predict confidently that people should stop getting hysterical about a wealth tax that isn't going to be implemented in the foreseeable future. Number two, if it is implemented, it would have to take out the vast number of people who are sitting on this call, who probably are middle-class people, for whom there would be no point in having a wealth tax, to be perfectly frank, because it's not going to bring in very much money, and the administrative cost will be greater than the revenue. And therefore, what I'm saying is that the wealth tax is raised up by all sorts of populists all the time. All we said was, okay, let's consider it. In order to consider it, let's see whether we're capable of being able to get the infrastructure in place which would allow a wealth tax to be implemented. The answer is that's not going to happen, because no work has been done on that. And until any work's done on that, I, for one, am not taking a wealth tax seriously.
Okay, so I guess it's a bit of a bittersweet response, Dennis, in essence, because I mean I think the sweet part of it is that it's not going to happen anytime soon. I guess a bit of the bitter part is that it's not off the table completely.
Well, nothing's off the table completely, Tracy. I mean, the fact of the matter is, because I keep, and as I indicated to you when we spoke about this, so much of this depends on the political outcomes of South Africa. I mean, I can't guarantee. I mean, let me give you a hypothetical which will put a shudder down everybody, which I'm not suggesting for one moment as a prediction. But if you took a hypothetical case that the EFF came into power, well, then, quite frankly, everything I'm saying at the moment would be completely irrelevant. But at this point in time and looking forward, the answer is no.
Okay. All right. So, Dennis, that kind of concludes then the wealth tax discussion in terms of a new wealth tax being introduced. We do now need to turn to our existing wealth taxes. And I think just on this topic, I think it is worth noting and just reminding everybody that South Africa does have a long history of existing wealth taxes. And really the purpose of this slide is just to show that in the 2018-2019 tax year, the amount collected from our existing wealth taxes is not insurmountable. It is a substantial amount that was collected. I think what else is important when we start touching on these other tax tools and existing wealth taxes, Dennis, is to bring the two Davies Tax Committee reports that were prepared on estate duty into the discussion. And, we did see some of the recommendations contained in those reports being implemented. We saw the introduction of Section 7C to counter the perceived avoidance of estate duty via trusts. We saw the estate duty rate being marginally increased. However, there were a lot of recommendations that weren't implemented. And the one, there were a couple. I mean, the one was the abolishment of the interspousal abatement. The other one was the increase in the primary abatement to 15 million. There was the inference around the abolishment of the conduit principle. And then there were also two items that were raised, and the recommendation was SARS needed to do further or conduct further investigation into those. And that was to examine the foreign trust arrangements, and secondly, to look at those offshore retirement fund arrangements as well. So Dennis, do you have an update for us in terms of these recommendations that weren't implemented?
No, but I want to just clarify a few things. Let me just try to get the reasoning. Let's just talk conceptually for a purpose and something which we would be pushing. I think there's a very big difference in annual wealth tax and estate duty. Perhaps I'm very old-fashioned, Tracy, and I kind of believe that if you give your children a really good education, they should jolly well get on and do it themselves and not have to be, as we say, trustafarians, where they rely on the accumulated wealth of the previous generation. And in particular in a country like South Africa, with the level of imbalance to which I've made reference, it's a far preferable route if you are going to worry about inequality and wealth than wealth taxes. Secondly, the other thing about estate duty, it's an existing tax. It's not a difficult tax to implement. The fact that it only brings in a couple of billion rand a year, in a sense, is the answer to your question. That for curious reasons that I do not understand, Treasury One and ministers, many of whom I've mentioned, seem to have been completely disinterested in estate duty. It's curious that people jump up and down about new taxes like a wealth tax, but don't actually consider that which is already viable in their own backyard. The idea of the 15 million rand abatement, which was not implemented, was that the late Matthew Lester and I, who really compiled that report, 15 was just a figure. And if you think about it, that's $1 millionaire, effectively, was to say middle-class people should effectively not have to pay estate duty on that amount. And if you want to bequeath that amount, as it were, to your wife or surviving spouse, as the case may be, that's fine. And if it has to be 20 million, it's an appropriate figure to say that for a reasonable standard of living, you should not have to pay any more. But for larger estates, the idea was to up the level and to be much more aggressive. in relation to that. In other words, in a country like South Africa, if, for example, you have an estate of over 20 million or 25 million, wherever it may be, then it seems to me perfectly legitimate to say, no, thank you very much. Over that amount, there is a tax to be paid. We haven't got a wealth tax. This is our only system. And I think if one can steer the debate much more into that direction and away from the annual wealth tax, it's a much more fruitful form of inquiry. But it is curious that it has been given very little attention for a very long time. What has been given attention, and again in the budget this year, curiously, are some of the anti-avoidance mechanisms, such as Section 7, capital C, with which you spoke, which therefore means that for people listening this morning, it does mean that you've got to look very carefully as to whether you want to use the trust as a part of your estate planning mechanism, and you'd have to have very careful justifications for why that would be, and it doesn't really have very significant tax advantages as it used to have in the old days. And it is interesting that in the budget review this year, there is reference to tightening that section because there are various forms of cessions of assets for very low rates, which essentially allow you to circumvent the deeming interest provision of 7C. So what is interesting, however, that's attacking it from a point of view of donations tax. It hasn't treated the problem of how you deal with estate duty with any measure. That's the only interest that they've had so far, and I find it curious.
Agreed. Yeah, agreed. So Dennis, I mean, just very briefly, because we do need to move on to the next topic, but just in terms of estate duty, and I think if we bring the theme of competitiveness in terms of rates into the equation, and in particular, if we look at estate duty, I mean, you know, on this side of the scale, we've got the US and the UK that have estate duty and inheritance tax rates of 40%. On this side of the scale, we've got Australia that's got zero estate duty.
Yes, but remember
say that
this,
we're in the middle.
Sorry, remember this. Australia have tougher capital gains tax regime.
Yeah.
Much tougher. Corporates pay 100%. There's no relief at all. And for individuals, there is certain relief up to 50%, not as much as we give, and in many cases, none. So you know, it's all very well saying they don't have estate duty, but you know, all right. So you don't want to have estate duty. Let's just make capital gains the same as income tax. Entitled. So what you win on the swings, you lose in the roundabouts.
Yeah, but I mean, the question was going to be, so is there scope for further increases in estate duty? I think that's just my question.
The answer is yes at the higher rates. I firmly believe that. Now and if you say, what is the higher rate? I would say a rate which essentially does not accommodate people within that 15 to 20 million rand bracket, maybe even slightly more than that. I don't think they should be subjected to anything. But over that, the answer, in my view, is given the nature of South Africa, yes.
Okay. So, Dennis, moving on to the next factor, and that's really the factor around tax morality. And in fact, this slide that comes up on the screen now, it just contains an extract from a report prepared by the OECD when they asked tax morale. And really, the work outlined several factors in terms of what may influence people's willingness to pay tax. But one of the factors that stood out for the developing countries in particular was trust in government. And I think, you know, Dennis, you raised in the Davies Tax Committee report on wealth taxes as well, you raised this issue around tax morality. And I mean, just to quote part of the conclusion in that report, you said the committee emphasizes the enhancement of existing wealth taxes, which we've touched on now, coupled with a decrease in unauthorized and wasteful expenditure, and enhanced tax morality will go a long way to reducing South Africa's unsustainable levels of inequality. So it therefore appears that at the heart of this tax morality lies the fact that people are happy to pay taxes, and arguably some are even happy to pay more taxes if they can afford it, providing these funds are being used for the purpose for which they are intended. So Dennis, what is government doing to ensure that taxpayers' money is indeed being used for the right purpose and to grow the tax base?
The short answer, Tracy, is far too little. And the short answer is that you are dead right. there is no doubt about it that there has been a massive decline in tax morality. When you measure tax efficiency, there's a factor called the tax buoyancy rate, which essentially measures the increase in tax take compared to the increase in GDP. If it's over 1, that means you're collecting more tax, your tax tax increases more than your GDP does. It indicates significant efficiency in the system. That was certainly the case in the first number of years in South Africa. It is no longer the case. And whilst it's true that we can thank the previous regime of SARS partly for that, it is also true that the fact is that given the level of corruption present in South Africa, that the tax morality declined because people said we were refusing to pay tax, which just literally gets thrown down the toilet or gets taken up by rent seekers. And you are absolutely right to say we've got to do something about that. And that's why I say that in a strange, weird and catch-22 type situation, the best mechanism we have for curbing corruption is a more efficient revenue service. I really passionately believe that given the problems in the NPA, you are not going to see thousands of cases being prosecuted over the next year or two, which are going to hold people to account. But I do think that it is possible under the leadership of Mr. Kieswetter, who has done a remarkable job in the last year and a half, that in fact we will be able to use the tax system. And again, I come back to an earlier part of the conversation. People listening to this call should be applauding that when we say this. They shouldn't be saying, oh, they're coming out to get me. We are not coming to get people who are legitimate, but we are saying this is our best opportunity. And you're right, until such time as government shows a determination to deal with corruption, until such time as perhaps we get the revenue service up and running in that particular regard, or the MPA, please God, I'm afraid to say I can only foresee a decline in tax morality.
Agreed. So Dennis, just in terms of, these interconnectivity between these factors that we've discussed so far, I think it does lead us to our last factor, and that's really the factor around the fact that wealth and talent are mobile. And I think there's a lot of interconnected factors that are resulting in this migration of talent and wealth. We've touched on a lot of those today. We could maybe add in security. People do fear for their physical security and for the physical security of their loved ones. And I think we have touched on a lot of those, so I'm not going to spend any more time on the other factors that we've considered. But I think just for government's consideration, I think, when it comes to wealth and talent migration, it's often the entire ecosystems that are linked to these individuals that actually get disrupted. And it's not just the individual that's leaving. Just as an example, wealthy own business, they employ people, so they contribute substantially to the fiscus and to the economy at large. And I think the other consideration is just around pool size. So really, Dennis, I think, if we look at the wealth and the talent migration, and if we also look at, and I hear you saying, as I said, it was bittersweet in terms of wealth taxes, but with this continued focus towards the taxes, the continued focus towards the wealthy, could this not be the kind of final straw that breaks the camel's back? And considering that the wealthy do contribute substantially to the fiscal already, and in fact, from government's perspective, they're their number one contributor, what should government be doing to retain both wealth and talent?
That's a great question. By the way, just one thing on the tax burden, Tracy. There's a page, I should have actually shared it, which shows the sort of percentage of tax on wealthy people around the world. And actually, we're slightly lower than Australia and a couple of other countries, interestingly enough. The tax to GDP ratio has basically been relatively constant, around 28%, maybe too high, but there it is. What should and let me make the other. So the point I want to really make is this: I know that people. Your point about breaking the straw that broke the camel's back is a good metaphor for the following reason: that people don't immigrate because of tax increases alone. So if you postulated a country with significant growth and with the fact that people were safer in their houses, and people felt there was a capable state that was managing all of these manner of crises, including the provision of vaccines, I think that you could increase taxes and you wouldn't get much immigration. You may actually get immigration, because every country in the world is suffering real trouble at the moment. But the real problem in South Africa is when you take the package of factors into account, a state that seems incapable of delivering, in the main, by the way, to people most in need, but to everybody in the case of vaccines, because we're all in need. If you take the fact of levels of crime that continue to be far too high, police that doesn't seem to be sufficiently efficient to deal with it, and then you couple that with the sort of populist rhetoric about we're out to get the wealthy, even though, as I've been pains to suggest, much of this is rhetoric rather than reality, I agree with you. We are in that position where we're losing serious talent. And what we've really got to, I think, look at right across the board in a non-racial and in a sense new South African prism is the idea that actually when we lose anybody, no matter their color or their gender, etc., their sexual orientation, to use the Constitution, who's got real qualifications and talent, that really retards any prospect of growth. And it really saddens me. So you did right. But I'm afraid to say these aren't tax questions alone. And somewise I get rather irritated by saying if you increase the taxes, people are actually going to emigrate. I think people emigrate because of a package of factors, most of which at the moment is that they've lost hope. They've lost hope that in fact we can actually turn the corner. And what we've got to do if we really want this country to cohere is to give people hope, and the government's got to do that first and foremost. I agree.
Yeah. So Dennis, I mean, we're unfortunately nearing the end of this session. And I mean, I could go on having this discussion with you all day, quite frankly, because it's really, really interesting. But as I say, unfortunately, we are nearing the end. We've got 3 minutes left.
Oh, yeah.
So perhaps you could just leave with the clients on the line today. Perhaps you could just leave with them some of your parting thoughts in terms of what does the future of their financial wealth look like in South Africa. And I'm going to have to ask you to try and keep it to a minute or maximum 2. But if you could just leave us with your parting thoughts, please.
I think that that number one, between Treasury and the Minister, and certainly the work that we're doing, we have no desire to actually overburden you or burden you any more in relation to tax. So I think you don't have to worry when you plan over the next 2 or 3 years that in fact there are going to be new taxes or increases in taxes. I do think if you are non-tax compliant, you might have to worry, but I've already said that. I think your key to your financial growth in South Africa really hinges on whether, in fact, the rather gloomy figures of 3% growth this year coming up and 2.4 the following year actually are underestimates rather than overestimates. Your wealth will depend to a large degree on, in fact, significantly greater growth prospects in South Africa. And if you think that they're going to be that, then to a large degree, globally and cumulatively, we will in fact be in a better position. But I would want to urge you to suggest that in relation to the take-home of this seminar is that actually the tax problem isn't a problem in relation to the accretion of your wealth.
Okay. Thank you, Dennis, for that. And thank you again, Dennis, so much for connecting with us today. We really appreciate your time. We appreciate your input, and we wish you well as you proceed with the chair of the Davies Tax Committee and all your endeavours in that regard as well. So really, ladies and gentlemen, we are now unfortunately starting to run out of time. So just as a reminder, though, despite the ongoing uncertainty, you do need to remember that there are things that we can control, and in terms of the things we cannot control, there are opportunities, there are those silver linings. We've just got to look for them. And despite this ongoing uncertainty, at Nedbank Private Wealth and Nedbank Financial Planning, we remain committed to giving you globally integrated advice and connecting you to more ways to manage and keep track of your financial wealth in a secure and convenient way. Planning for the unknown throughout your life journey is one of the cornerstones of sound financial planning. And it's also important to remember to regularly review any plans that you do have in place, because they do need to remain up to date considering your personal circumstances, aspirations, needs, and life's goals. So how can we help you protect your financial wealth? Well, we have a team of fiduciary specialists that work very closely with your financial advisors, and together they can prepare a plan for you to help you be prepared for that unexpected. So really, in closing, if you would like, we are going to be having a smaller conversation starter webinar that we call it a conversation starter. It's going to be a smaller webinar. The date is up on your screen. If you would like to join us, you can put your name in the chat function now, or when you do get that follow-up email, you can just let us know in that. We'd also like to just once again thank everybody for joining. If you would like to see any of our other thought leadership insights or see any of our other webinars, the recordings or what's coming up, please visit our website. And please also, your views matter to us. So please let us know how we can improve our webinars going forward. Thank you again to Dennis for joining us, for sharing his insights with us. And finally, but by no means least of all, ladies and gentlemen, thank you for joining our webinar today. We look forward to connecting with you again soon. And until then, go well and stay safe. Thank you.